All right, we got Mike Mazur on the podcast today, niche real estate investor, here to pick his brain on different parts, different sectors within real estate you can invest in that you probably haven't heard of before.
Great to be back, Drew.
Listen, everybody, we all know that real estate is the most proven way to build wealth. But why isn't everyone wealthy from real estate then? It's hard to know where to start, and most of the education out there is just complete trash, and you end up investing your money on a series of courses instead of in real estate. That's not how this podcast works. We give you the blueprint to successful real estate investing and bring on guests actually willing to share their secrets. I started my real estate investing journey as a freshman in college when I bought my first duplex and have been in the trenches doing deals ever since. And today, I now own hundreds of millions of dollars of investment property. On this podcast, you will learn what you actually need to know to be a successful active or passive real estate investor. And we'll offer our takes on what's happening today so you can navigate this market and build wealth. I'm Drew Brenneman, and this is the Brenneman Blueprint.
So, I mean, you've really carved out a really nice career investing in all these different sectors within real estate that I don't really know anyone else investing in most of them. Where, I mean, just to kind of bring people up to speed on what you've done, where maybe I'll go with it. Or
yeah, go ahead.
Okay. With post office properties, I mean, last time I talked to you, you had bought like a couple hundred of those, and we're building a big portfolio. Now you're on to self-storage and building up a platform that, I mean, potentially could be something that IPOs someday. And a lot of times when we've talked, I mean, you've had all sorts of other ideas on like, hey, what about vet clinics or dental practices rolling up these? So let's talk about all that today.
Yeah, sure. Absolutely. So by way of background, I've invested in like, when I think of the major food groups in real estate, it's like multifamily, office, retail, and hotels are kind of considered like the most classic real estate investments. And then in terms of like niche investing, I think it's expanded into like self-storage, senior living, marinas, data centers, like products are, and actually most recently like life science.
Yep.
Research facilities, I think, have become really popular. So it's hard to find a niche where someone isn't playing in yet, or where there isn't a lot of institutional competition, or like in the instances of like self-storage, where even though there's a lot of institutional competition, there's enough ma and pa investors out there and people you can buy from where you can still add value by being an institutional investor. And so, you know, that's what we were doing when I was at American Postal, and I was heading up acquisitions there. We purchased over 500 properties, and I was in charge of while I was there and scaling up that business. And so, you know, when I think about niche investing, it's like a combination of what can you do, what can you do to grow rents better than like a ma and pa individual? Are the cash flows safe? And if they're not safe, what can you do to grow rents where you get paid for the risk that you're taking? And so like in the post office example, it was like, well, you know, the USPS is the credit behind your post office, which is pretty wonderful. You know, there were a lot of ma and pa investors that were worried about the post office leaving, whereas us, like, we knew that the post office had a really high renewal rate, and we were trying to manage them. We were trying to manage rents to market, manage the post office for the future, and it was like we had a completely different approach than someone who just like casually owned one. And so, you know, as I thought about that, like, One asset class that I've really liked has been veterinary clinics. There's over 22,000 of them throughout the country. They are being rolled up right now by private equity. And actually, that's the way that I found them. I was like, what asset classes are private equity investors that maybe aren't so interested in commercial real estate components like rolling up because they see value in the business? And so I looked at like two years of data, and one thing that I was surprised by is that a lot of private equity companies around the Midwest were buying veterinary clinics, and it was surprising to me. I dove into it a little bit more, and what I realized is that overwhelmingly, like, it was a very recession-resistant industry with year-over-year sales growth like crushing inflation. And so I was like, oh, okay, I understand that now. And then what I realized as I was going into it more is that there's over 60 private equity companies that were aggregating up these practices where you have ma and pa credit, and then they were expanding into like larger portfolios and either selling themselves or buying other people and aggregating up further. So in my mind, I was like, well, here's an opportunity where the entire profile, the credit profile of the industry is improving. It's going from ma and pa to institutional, but as many people know, private equity usually has a lot of debt behind their acquisitions. And so it's like the asset class is improving, but it's not like extremely stable right now. But I found that appealing for like an asset class to go into. So I dove into it further. And what I realized was people that were in veterinary spaces tended to stay in their buildings for a long time. They had pretty stable cash flows with very little landlord responsibility and ability to push rents like 2 to 3%. Sometimes it's CPI, which, as we know now, is like extremely beneficial to have as it's part of your lease, and incredibly easy to manage. And so I kind of like that combination. So I purchased with like a couple friends of mine a veterinary clinic last year just to kind of see what it was like. And I was delighted at how simple it was to manage. We're able to find like a 13-year lease term that was owned by one of the major aggregators around here in Chicago at a cap rate that was giving me like a double-digit cash-on-cash yield. So I felt great about that.
Nice.
It's like a core asset. And so my thinking was, if these things are easy to purchase, it would be really nice to aggregate these up into like a portfolio that's big enough where maybe somebody more institutional would be like, oh, it's nice that I don't have to go and cobble up all these individual properties together, and I can just do it and I can just, buy it from Mike. And so that was my plan. I still really like that idea, but I haven't been pursuing it that actively recently just because interest rates went up so much. When you have like a fixed rental stream like triple net properties like vet clinics, that matters a lot. Where it doesn't really make sense for you to buy these things necessarily with debt until the cap rates start going up a lot in a space like veterinary clinics. What's been really interesting is assets like veterinary clinics or post offices haven't been moving in lockstep with interest rates. I think people look at those assets as being relatively safe or recession resistant. And so like cash buyers have continued to acquire those types of properties right now. So right now I'm like on the sidelines hoping that cap rates will ultimately end up going up and then continue to grow from there. But it's that type of thinking and like the logic tree that got me into being like, oh, vet clinics seem like interesting for the reasons I had mentioned before, is like, that's what I consider niche real estate investing. Like that's what's very appealing to me. As I like think about ways that I would want to grow my real estate portfolio, both like professionally and like working for others as well.
But now to back up a second, so let's drill down on the deal you bought, because I think your average person listening to this podcast, they probably don't work in private equity or are going to be maybe aggregating portfolios, but they might buy a 3-unit for $700,000-800,000. Let's say this is the Chicago price, at least.
Yeah.
That's a high number, but I would guess the clinic would have been around that number, maybe less. So let's walk through that deal a little more.
Yeah, sure. So it was a property that we were buying for like around a 6.5% cap rate. It had a 13-year lease term with rents growing at 2%, where there was very little landlord responsibility. And so most of like the costs of maintaining that property fell onto the tenant as being the responsible
So
party.
it's a triple net lease.
It's almost a triple net lease where like you're responsible for the roof.
Okay, a roof replacement.
Yeah.
Or okay, yeah. I mean, then that if for folks not familiar with that, it's a simple setup where the clinic or any tenant, if they say it's triple net, they're paying their usual base rent, but then also Mike will send them. Usually they pay it monthly, like an estimate, and you true up at the end of the year. But Mike will it'll pay all the bills to run the property, and the tenant reimburses them. So for property taxes, insurance, for everything, running, snow removal, except for a couple items on the roof here on this one. So I thought triple net, it's like if it doesn't include the roof or like anything, then it's like, I don't know, absolute triple net or something, where I think triple net still has the landlord with some CapEx things like structural, which I would consider roof to be. So I guess that's what most of our retail deals have, at least. So
Very fair comment. I think that those definitions blur based on like who you're talking to. I guess absolute triple net and triple net to me are the same thing.
yeah. Well, anyways, that's two in the weeds. But so we got this like fixed stream of rent that's growing 2% a year, and then if the operating costs change at all, that gets thrown back to the tenant. So continue. So 6.5 cap, you said?
Yeah.
What was your interest rate on this?
Our interest rate was like 3.5%.
Okay, nice. That's a big spread. So
Yeah.
that's a lot of cash flow,
Right.
is what I'm hearing. And then what was the purchase price of the whole clinic?
It was right around 1.3 million. So it was a little bit bigger than your 3 flat, but still like on no institutional radar.
Yeah. And then how the money to buy that? I mean, where that was your the equity, the down payment?
Yeah. There was a down payment and equity that we had funded basically through through friends who were interested in investing with us.
Nice.
And then we had a loan on the property.
Where'd you get the loan?
We used a local Chicago bank that I was lucky enough to have good relationships with.
Okay, great. So yeah, then you borrow at 3% and it a 6.5 cap. That's like what it would make. Another way to think of that is that would be your cash yield per year if you didn't have any debt on it. So then, if the property's paying out 6.5%, Mike put some down and then also borrowed the rest at 3%. So there's a lot of excess cash being thrown out.
Correct.
What do you think you're making if you had to guess? Like, now what I like to do in my deals, how I think of like how much money am I making, let's say, in a year. I don't factor in appreciation at all, actually. Like, I just think cash flow plus what I pay the loan down, that's what I made this year. The rest is like potential earnings is how I view it. Obviously, if I sell a building, then that's like different, where then you realize that gain. What do you think on this deal, like your return would be per year if you were doing cash flow plus paying your loan down?
So for this, for the first year, we were right around like a 11% return.
Nice.
Yeah.
And then it'll just grow slightly from there as the rents go up.
Yeah.
Nice. How long? What kind of loan term did you get?
We had a 5-year loan with 1-year extension.
Okay, nice.
And we'll see how we want to handle it over time. If we'll want to sell before that or try to refinance the loan. Part of that will depend on if we can continue to grow out the strategy, which is something that I would very much like to do. It's just that the spread between that type of spread, like 300 basis point spread between interest rate on cap rate, it's not really there anymore.
Right. Yeah. Now you're borrowing at 6% if you're lucky, and cap rates moved up, but not as much as interest rates moved up.
Right.
So maybe what's that today? Like a 7-something cap.
It's probably like a 7-something cap and like a 6% loan or something like that.
Yeah, I would think so. And then too, most of these commercial deals, they're 25-year amortization. So then you're paying more principal than maybe your run-of-the-mill apartment deal down too. So there's less cash flow from that.
Right.
So, No, that's interesting, but that's a high return, and then 11% year one, with not including appreciation, and then with no work to do essentially. You're
Very minimal work. Yeah.
you got to do some to set up the services for snow removal and landscaping and get these things going, and then pay the bills, get reimbursed. But it's almost like a lot of the work is like accounting work on these commercial deals,
Right.
and where there's very little like property management in terms of like tenant interaction with like the stuff you'd see in an apartment deal, where if the toilet at the vet clinic's overflowing, which is your most typical property management stereotype, let's say, the vet clinic is responsible for their own toilets in triple net deal, so they're not calling Mike.
Right.
So, but then what would so then your average person, let's say they got they could buy like one of these, like what would you recommend they would think about? Not get into where we're rolling up portfolios, but maybe I'm living somewhere where I was going to buy a multifamily property for 700-800 grand, but now I think maybe, what about dental clinic, vet clinic, post office? What do you think?
Yeah. So are you asking in terms of like other niches that could be interesting, or in terms of like what they should be thinking about if they've identified something they think they want to buy?
The latter. Like what should, like if you were, let's say you're on Bigger Pockets or something, you're learning about apartment investing and you hear this, like, to me, I'll answer this and then you can throw in what you think's the important to know biggest difference. The lease term is so important. Like that, which you just kind of think like, oh, like these tenants, I'll just assume they always renew and it doesn't cost anything for them to renew. These renewal negotiations are a bigger deal than you would realize compared to like an apartment deal, where they're always going to be asking you for something. At least I've done a lot of multi-tenant commercial deals, and they're always telling you this sad story about everything's going poorly with my business, and I need a new HVAC unit on the roof, and I need my rent cut, and this and that, and I want to do a 1-year extension, and they're just singing you a sad tune while they're doing just fine with their business. And then so like it's renewal and lease timing are so important in this. And then in apartments, you can just sell at any time. Like nobody really cares about what your lease term is in an apartment deal, in my opinion. Your lease could be ending in 3 months. Any buyer in an apartment deal is just going to assume, well, whatever, I'll just re-rent it if these people don't renew. Whereas with these vet clinics, any commercial deal, it's not like that.
Yeah, they're going to look at the weighted average lease term, either of your portfolio, or if it's just your single property, the lease term matters tremendously, because it's just like what you said, that's where the asks come in as you start thinking about the renewal, and then there's the renewal probability of them potentially leaving. And if they do, what would it cost for you to get a new tenant in there? And so it's a combination of like, you see this sometimes with brokers where they'll have a deal out there. Maybe it's a dental office where it's like, yes, this dentist only has 2 years remaining on the lease, but they've been there for 30 years, so they're definitely going to stay. And then they want the 30-year premium that you're not getting in your property. You have a 2-year lease term, but they want you to accept the fact that they're probably not going to leave because they've been there for 30 years, which you can't really look at that.
Yeah. Yeah. And it impacts everything, where let's say on the deal you bought, you said it was a 13-year term, and then you did a 5-year loan. So if you want to sell it at the end of year 5, you're safe. You got 8 more years of term. But let's say you renew your loan again for 5 years, you want to sell right at the end of that. And now maybe let's say with the 13 years, you're rounding a little, and it's really, 12.8 years. Let's just pretend to make the example work. And now you sell when your loan's wrapping up, and you got this vet clinic deal with 2.8 years of lease term. Everybody looking at that's like, wow, in a year you're going to be talking about a renewal. And every lender I talk to, I ask them for a 3 or 5 year fixed. And in commercial deals like these, the 30-year fixed not common. So that's not offered from these banks. And then they go, this is hard to finance.
Right.
I'm worried about the renewal. So these deals aren't always sellable. Like an apartment deal, like today you get the same price always in an apartment deal, seemingly. Related to the term, you could have a really low rent or something else could be going on, and you don't get peak pricing.
Yeah, well, I mean, what I would say is, as an individual investor, it doesn't make, unless you're getting paid handsomely for the probability that there's a tenant that's going to leave. It makes more sense to have to have a longer lease term, unless you're thinking about purchasing a bunch of properties at once, where you start thinking about it more as a portfolio, and you're like, well, four of the properties that I have like a 15-year lease term, so I can take the risk on this one guy who has a 2-year lease term, especially if you're working with the same lender, or you're looking at it as like a more portfolio acquisition, where it's like, even if I have to leave this space vacant for a year or two, I still cash flow enough where it's worth it for me to take the risk. And that's where it's like the mindset changes from the individual asset to more of a portfolio decision, which is ultimately where, I think it makes sense to go with these types of niche investments, where it's like you have one, you have two, you start having 10, 20, 30, like you can go up or down the risk spectrum in a way that somebody else, maybe it's not as beneficial for them to do that, because it's just one component of your weighted average lease term and, the cap rate of your entire portfolio.
Yeah, it makes sense. Where then this speaks to building a portfolio and building this out. And yeah, one of the investors partners I have in some of my deals, he owned an industrial deal on his own, was concerned that the tenant was going to blow out of there, so he sold it. And on that individual deal, he like timed it all perfectly, like got a new lease, let it go for a couple years, and then sold. He thought they were going to leave or go out of business. But when this company that bought it was selling they were doing a industrial building, like roll up to sell as a portfolio. When I saw the portfolio for sale, this deal was like 0.8% of like the rent roll of the, weighted, the total, let's say, NOI for the portfolio. And so to them, it was the same thing. Like, yeah, this tenant might go. It's not even 1% of the income. Like, it's a good buy, we think.
Right.
So,
right.
Makes sense. Wanted to ask you too, what do you think about co-working? Like, that's like a niche. I see people opening up like one-off, like WeWork locations.
Yeah, I never really understood the co-working concept, just because they, if they're a tenant in a building, they have to pay a fixed rent, but they have a variable like cash flow stream coming from like the different tenants that are renting in the co-working space. So it seems like when people stop using co-working, or it becomes less desirable even for a short period of time, like that makes it very difficult to run the business. So I always struggled a little bit with the idea of co-working and how it made sense. And I mean, like, I know some businesses have like purchased their own office buildings, and then like depending on the capital stack there, they can take that kind of risk. But I think that remote work probably did a disservice to the co-working industry, because I think that a lot of corporate users were using co-working space as an opportunity for them to potentially have like flex office space. But with people's comfort in working from home, I feel like it narrows your audience of people that wanted co-working space versus where it was like 3 or 4 years ago.
So then that's a niche you wouldn't recommend people start opening up their own.
I'm not a big fan of co-working, but I mean, I'm sure that there's people that have done very well in this space and they understand it much better than me. I never really understood it as a business. I always kind of struggled with it.
Yeah, I mean, it's sort of like the whole savings and loan crisis, where they got all upside down, where they had all these long-term loans out and all these like shorter-term, ways they had deposits and were paying out interest, and then it all got pulled out. And same thing, you're signing a 15-year lease or buying a building and just rent it to people by the day or by the month. Things can change really fast.
Right.
And office is just, you could almost say the same thing about some of these, like you could almost say what I said about hotels or apartments or self-storage maybe, but office is just perpetually like a tenant's market. meaning like the market is like 80% occupied or whatever it is. And it's just always the balance of power is always in like the tenant's hand. So it's not like some of these other ones where you have like such strong occupancy and rent growth where having shorter term leases can almost like work in your favor. Like if you have like a hot hotel or something, you'd be happy you didn't sign like year-long leases. Like you're going to be able to charge more every day as you get into either peak seasons or you get more popular.
Right. Yeah. For me, when I think of niche investing, like where it gets really interesting is smaller asset sizes where you aren't necessarily competing with institutional investors because it's not on their radar. Like it's easy for an institutional investor to purchase like a large industrial building, even if they're not an industrial, and like understand it and acquire it, and you have to compete. It's less easy for those people to be like, why would I buy it? Even if they're in the triple net space, why would I buy a vet clinic? It would make more sense to be like, well, there's 100 vet clinics at like $1 million that you could buy from this one person. And so, the theory is you get paid for the work of aggregating up the industry. And so it's like, you've seen this a little bit in the storage space. There have been some really interesting acquisitions where, when you think of like traditional self-storage, you have a facility that's like 40,000 square feet or larger, you're amongst hundreds of tenants, and their attachment to the area is that they're within a certain radius. What we've been seeing in storage is that some people are trying to get smaller. Some institutional investors are trying to get smaller instead of trying to grow into larger footprints, smaller ones. So like there have been some companies out there that have been looking at like 50 unit apartments and saying, hey, there's this dead space in the basement where there used to be an office, wherever. What if we built storage for the users of this building specifically? And they go to the landlord and they say, hey, we'll revenue share with you. So we'll put storage into your property or into your basement. We'll revenue share. There's no lease. And they grow the business that way, where it's like they'll have 20 storage units for 50 apartment units, and that's it. And people have been scaling up those types of businesses. So there's niches within like these secondary real estate asset classes that are really interesting, where it's like it doesn't really make sense for a major REIT to do that once, but if you have 1,000 of those types of arrangements, maybe it does, right? And so it's like scaling up these businesses that you see the value in on a micro scale, and then building it up into a portfolio, I think is like the most interesting way to niche invest.
But then for those who don't know, like what's the benefit to building the portfolio? Like where do you see it?
Yeah, so for me, the benefit is in like the operational efficiencies. So here's a good example, like for the veterinary clinic, or actually let's stick with the self-storage example in the basement, where it's like you have to monitor who's renting in the space. You have to go through the accounting. You have to make sure that like the LLC is in order, in good standing. And it's like all of the operating things that don't take a lot of time, is easy for someone like me or you to do on the side if we have one building. But if you had like 1,000 of them, then all of a sudden like those concepts become somebody's job. There's like there's an efficiency to scaling and to sizing it up, where it's like instead of having like Mike or Drew or anybody else who's considering like a niche investment, have this be like something that they do on the side, like they can create a proper business out of it. And normally you can get a cap rate premium when you ultimately decide to sell because of the work that went into it. So let's say, you were aggregating up the post offices theoretically at like a 6.5, maybe 7 cap, if you start scaling them up into a meaningful level, like you would expect some kind of premium for doing that. 50 basis points, 100 basis points beyond the cap rate. And that spread between an individual asset and a institutional premium, if you acquire to a big enough scale, is large enough where it's worth the work.
And I already know the answer, but I'm trying to drive it home. Like, but what is that cap rate spread? What does that like mean, like more practically, like in terms of dollars, or what's happening?
In terms of like how much of a spread do people typically get?
Yeah, or I'll just try to say what you're saying, like maybe a little differently then. Where
Yeah.
like in some of these product types, and I feel like in apartments this doesn't really happen, where the cap rates are not that different across the deal sizes. Where sure, like your trophy institutional amazing apartment building will go at a lower cap rate than one that's maybe like a smaller one, but then you kind of have this weird dynamic where on the lower end size wise, like the sizes you're talking about, the $1-2 million deals, you have individuals that are just paying crazy numbers sometimes for them, where they're just investing their own money. They might be self-managing it, so they're not even underwriting full expenses. And so I personally haven't seen anybody buy like a bunch of $2 and $3 million buildings, let's say for apartments, and then sell them as a group and get any kind of premium when they could have just sold them off one by one to these, let's call them like beginning investors that are paying big numbers on the mom and pop side, where on these like let's say in the industrial world, I saw a great example where there's a guy in Minnesota who sold his whole portfolio. Two individuals that sold. One was someone who sold a $200 million one, and then a $500 million industrial portfolio to Blackstone. And on one-off basis, those things were, like you're saying, where maybe you sold them off one by one, let's make up the cap rates here, would have sold for 7 caps. But Blackstone's looking at $100+ million deals only, let's say, and because they have billions of dollars to put out, and they can't, I mean, you only put in 20-30 million at a time. How do you invest billions that their funds have? And all the deals they look at, they're more like 4 and 5 caps. So then they see this portfolio come through and they're like, oh, 5.5 cap, or whatever it was. I don't know the numbers on those, but I'm trying to just explain where all of a sudden you go from maybe one off that portfolio that guy sold to Blackstone would be worth $150 million, but to Blackstone, they thought it's worth, to them at 200 million, it looked like a juicy deal. And then they're putting that in this, in their industrial platform that has, like, last time I checked, like 10 billion plus of industrial assets, which they call logistics. And now it's not worth 200 million to the next buyer when they sell it to the Singapore pension fund or whatever they did last time. Like, it's going to be, so that's, I'm trying to just drive home, like, why would there be a premium? Because to the average person listening, it's like, well, so what, you bought like 10, I don't get why these are worth more. But it's because if you can get it to a size where that bigger buyer is looking, that's used to paying lower cap rates, which means a higher multiple for what it makes, then to them this looks like an enticing deal, and they're only looking at stuff that a lot of times these bigger deals, the institutional investors, they have a lower cost of capital on the equity side and then also on the debt side.
I think that's right. And then the other component to that, though, is it evolves from being something that you can do on the side to something that generates enough cash flow where it's a proper business. And there ends up being like an enterprise value to the portfolio that you created, right? Like, you've created a portfolio of Y, which is big enough where somebody else can take that Y and like grow it out into something much bigger. And they have enough cash flow today where they can hire staff that could support that business. Where it's like, it's not like, I don't think that these like larger institutional investors are just like, oh wow, we pay really aggressive pricing for everything. This seems relatively cheap to that, which I think is true. That like might initially get them interested, but it's like there's enough cash there where they can pay people to grow out that business. And I think that's part of the portfolio premium. If somebody else looks at you, the small guy who is like, I aggregated this big thing, and they're like, yeah, that's great, we'll take it. and they're like, this thing is really small in their perspective. Now we're going to make it really, really big, like
Right.
properly, like
Yeah.
institutional the way it should be. And so they see value in you, like in you creating what is a beginning to them, to a
Yeah.
bigger business, as opposed to you being like, this is way more than I can handle.
Yeah, no, that makes sense. And I do think there's also a piece where like the people buying at, vet clinics at, 7-8 caps today, borrowing from banks at 6.5, like that deal makes a certain return. But if you were to sell 100 of those, 200 of those to Blackstone, they're not going to go borrow at 6.5. Like they have a totally different arrangement. So then,
Right.
so
That's
then
true, too.
to them, they don't think this is like, they don't think they're overpaying. They're going, wow, we haven't seen a $200 million deal with such a high
Generate that
cap
kind of
rate.
yield.
Yeah. And then to them, all those benefits you're talking about when you get the portfolio built up are there for them. They're going, this is really a great rent roll. It's 200 different businesses operating independently. It's like at that point, it's basically like an apartment building from like a rent roll standpoint. There's 200 different families in the building, let's say, and they're all making money independently. And it's not like, and one thing's is tied to it. So, makes sense. What else should we hit on here?
I don't know. I think some of the things to think about too is like when you're aggregating up smaller assets, and I'm sure there's like a lot of podcasts that go into like due diligence and what you should do. Every couple $100 matters when you're buying like an $800,000 asset or smaller, or even bigger, a little bigger than that, where it's like, it's hard to justify like an expensive attorney. It's hard to justify like all the different types of third-party reports. So I think something that's really important that people need to think about is like what reports are important to them. And so for me, it's always like environmental report, property condition report, and then like depending on the asset, like you need a title report. But then it's like where it gets a little more murky is like, what kind of survey do you get? How much should you be spending on legal? Like that ends up really eating into your yield. And it's like, you have to be very careful with that. So, everybody is different in their approach. But for me, like environmental and property condition report are the most important things that you get when you're going through an arm's length transaction, and understanding the lease that you're signing onto. Because I think what's very typical is it's like we had the conversation at the beginning of this. Well, that's absolute triple net, Mike. That's not triple net. I mean, brokers kind of say the same kind of stuff where those definitions are fluid. You really need to make sure what your landlord responsibilities are if you're trying to just purchase like a single tenant property and rolling that up, because what a broker may tell you is your responsibility and what your actual responsibility is when you look at the lease are different. So what I would say is read all the leases carefully so that you can understand them. Ask questions if you don't, and be careful in your due diligence spending.
Yeah, it makes sense. Where, I mean, so like buying one of these properties, there's not a realtor form contract to use. So then you usually have a custom attorney drafted contract, which, I mean, depends how complicated the deal is. And I mean, I've probably, depending on how complicated some of the deals I bought, I've spent probably between $2,000 and $20,000 on a purchase contract before, depending. Right. And obviously, if you're buying the $20,000 contract was on, a $30+ million building, wasn't on a $800,000 building. That wouldn't make any sense.
Right.
But so point being, so then if that's something you can get a contract you can reuse, if I know something you've talked to me about, or ways you can save, or figure out what's important to you, and then not overspend. Makes sense.
The other component too is like if you have a lender, it's important for you to understand what's important to them. What kind of contracts are they going to be using? Are they going to be using a form contract, or are they going to be using some kind of custom contract, or custom like loan documents? And so like it's really interesting. Like sometimes diligence for these smaller properties is driven by what the lender needs. My lender needs to have this kind of environmental report, or he won't give me, or she won't give me the money. Like that's not unusual for assets of this size, where it's like you have to recognize what's important to you, but then it's very important to understand like what diligence requirements your lender has, if any. Sometimes they don't have any, depending on like if it's a recourse or non-recourse component, where it's just like they expect you to be responsible and figure that out. And so just having an understanding of like your entire capital stack, what matters to you, what matters to the lender, what will matter to show to like anyone who's investing with you that the work that you've done is like an important thing on the front end to think about.
Yeah. And I think I don't think we've actually touched on maybe what could be the most important part of like niche investing. Like what's in my opinion, the number one benefit we haven't talked about. Think about that. In my opinion, cause I'm in what's the most crowded space, I'd say, maybe industrial is more crowded, but I invest in multifamily and so do a lot of other people. Whereas, so any deal that comes out, you know, if it's brokered, there's a lot of activity. It's getting multiple offers, and things generally aren't just going for like wild mispricings. Whereas on some of these smaller one-off deals, I mean, you might be buying a vet clinic just off the veterinarian. Doesn't really know, not in the real estate space. They're not giving it away for free, but they're not also, reading whatever we be reading on where valuations are. And you're dealing with a totally different seller potentially, and then also competing buyers.
That's a spot on comment. In fact, I've done deals before because I sent out a postcard to a seller directly. And when you talk about transaction costs, the same is true for a seller. When you are working with brokers on the smaller deal size, a broker doesn't want to work on the property unless they can get a big commission in terms of a percentage of sale. So they might be asking for like a 6% commission from the seller. The seller's looking at that, and then they're saying, oh man, I just got this postcard from Mike. Maybe I'll call him and save on this commission. And like that, it seems silly, but it's not, because like every dollar matters when you're on the smaller side like that. And so it's like there's a preference to work directly.
Yeah, and then you hit them with, I got a form contract, so we can start with that. You'll save on
right.
legal.
Yeah.
Sounds pretty good.
Right. And so it's like it's a different attitude. It's a different investment group that's there, especially if you're interacting with somebody who maybe hasn't done a commercial real estate deal, but they have this building that they've owned for 30 years. And so there's a little bit of hand-holding that might have to go into that. Maybe they're very sophisticated, but they also don't want to spend too much money. And so it's like, yeah, your competitive pool is smaller from the purchasing side, which is an extremely attractive quality.
I mean, to me, the number one benefits on niche investing are top ones that always come to mind, like rolling up one of these kind of portfolios. It's, it's way less competitive on the buy. You're buying smaller properties, typically competing with way, way less people. Like think about how many people, when you talk to the average person, if they invest in real estate, odds are they're not buying marinas or vet clinics or what have you. Like they're buying apartments. So you're not in as crowded of a trade. You should return and getting higher returns, just being less competitive. And then you have like the income is so like it's not correlated with the economy as much. Like you have these long-term contracts with a lot of these things are more necessity driven. I mean, we're talking about a lot of like medical and postal and whatnot. I mean, obviously like the marina's not, if in that example, or co-working, which is why that's another, I can see why that wasn't your favorite, where that's a easy cut if you're a business. Like we had this month to month extra office space, let's dump that. But a lot of it's not really correlated to the overall economy, that's an important part of real estate investing, in my opinion, where you've invested in your stocks, your mutual funds, your bonds, what have you. And in general, real estate's not correlated with that stuff. And then this would be even less correlated. Like what is the income from a vet clinic? I mean, that's like a solid, need-based business that basically seem to never close.
Agreed.
So those are my top two before you even get to like, maybe if you buy 100 of them, you could sell them at a big premium. And most people never get to that point, so this is like a big, two big pluses, especially the not being crowded. I think about that all the time when there's, an apartment deal I like, and then it gets 20 offers, and then I don't like it anymore.
Right,
I'm like,
of course.
okay.
Or
like,
if you want it, then how do you feel about it?
yeah, right. Yeah, 80% of the deals I bought still have been off market, usually through a broker, not like direct, like the postcard thing. But I do think that like you want to not be in like a crowded trade, and then you see a really nice apartment deal come out, and then it gets 20 offers, and you're like, oh, okay.
Right.
Talk to you later. So sweet. Well, yeah, let's leave it there. Awesome. Thanks for being on.
Thank you. It was a pleasure.
Cool. Anyway, how do people get in touch with you?
People can always find me on LinkedIn, or they can send me an email at mmazur@elmdalepartners.com.
Perfect. Awesome. Great job, Mike.
Thanks
for being on.
Thanks, Drew.
If you learned something from today's show, leave a review and hit that subscribe button wherever you enjoy your podcast. Dive deeper into real estate investing on Brenneman Capital's website, brenneman.com, where we have numerous free resources and information that can help both active and passive real estate investors. Accredited investors can get started today as a passive investor in our multifamily investment opportunities by hitting the Invest Now button on our website.
The views and opinions expressed in this podcast are those of Drew Brenneman and guests as of the date of recording and do not purport to reflect the views or opinions of Brenneman Capital LLC and its subsidiaries. Views and opinions are provided for informational purposes only and should not be relied upon or deemed as investment or tax advice or an offer to buy or sell securities. The speaker cannot be held responsible for any direct or incidental loss incurred by applying any of the information offered.